Firm's cost of capital, what exactly is it? It's the expected return of the firm's assets. The way we can figure out what the firm's cost of capital is the weighted average cost of capital, WACC. So in our approach to WACC, first we're going to look at how to compute it. It's going to be some number crunching. Then the second thing is what's really critical is how do we use it? Its importance and its relevance. So it's important not to simply get caught up in number crunching, but to understand then, okay, now that we've crunched a number, how can we use it appropriately? So before getting into it, we want to talk about how corporate taxes are an important consideration. They need to be taken into account because interest payments on debt are tax deductible to the firm. The firm gets it treated as an interest expense, and so when they make an interest payment to their investors, that actually has an influence on taxes. And we ignored this in project analysis because we wanted to focus exclusively on the cash flows produced by assets. And one way to think about it is that suppose the decision to borrow or issue stock, or the financing decision took place first. It happened, it's etched in stone, the firm now has a pile of money, and then we did project analysis to say, okay, what's the best way for us to use this money? However, we don't want to just leave it there because the way that funds are raised actually can issue cash flows, and therefore we need to take into account tax deductibility. And that gets incorporated directly into the WACC. So when we talk about pre-tax cost of debt, that's the expected return from the investor's perspective. It's the yield to maturities for bonds. If I'm an investor and I expect a return of 10%, the yields on the bond have a 10%, that's the pre-tax cost of debt to the firm. And if it doesn't specify pre-tax or not, cost of debt refers to pre-tax cost of debt. Cost of debt, yield to maturity. However, the after-tax cost of debt, what it truly costs the firm, is different than what the investors expect. And in particular, you've got your pre-tax cost of debt, which is your yield to maturity, times 1 minus the tax rate. And the reason is because interest payments are tax deductible, and therefore they lower taxable income and they lower taxes. So again, taxes paid are a real cash flow. And what are they? They're equal to taxable income times the tax rate. But if a firm makes an interest payment, then that lowers taxable income relative to EBIT. So the greater interest, the more interest that's paid, the lower is taxable income, and the lower is taxable income, the lower is taxes. So specifically, taxes saved, tax shield, interest tax shield, is the interest that's paid times the tax rate. If the tax rate, let's say, is 30%, then the firm pays $100. That's $100 it doesn't have to pay taxes on. That's $30 that it saves, and so taxes are reduced by $30. Therefore, the after-tax cost of debt is equal to the pre-tax cost of debt, what the firm pays to its investors, minus pre-tax cost of debt times the tax rate, which is the tax savings. And so pre-tax cost of debt, yield to maturity times 1 minus tax rate. And you can think of it as, like I just said, what's paid minus what's saved in taxes.